Okay, let's kick off with a really bold idea today. What if becoming a millionaire trader, consistently successful, wasn't about some kind of innate genius?
Or like having secret insider info.
Exactly. But instead, it was just a process, something methodical, something anyone could actually learn. It kind of flies in the face of what most people think, doesn't it?
It absolutely does. Yeah, the
Right.
common wisdom is that fields like finance, especially trading, well, it hinges on talent, right?
Right.
Or some gut feeling you can't teach.
Right. This idea just turns that completely on its head.
Uh-huh.
And that's really our mission for this deep dive. We're going to unpack one of the most, I think, fascinating experiments in financial history. It all started with a simple question. Can successful trading actually be taught?
And we're digging into The Complete Turtle Trader by Michael Covel from 2007. It's a fantastic telling of this story.
It really is.
And the book, it basically argues that trading success, it's not magic. It comes down to having the right system, real discipline, and the right mindset.
Yeah, mindset thing.
It shows how, regular people got these incredible results.
And what that might mean for you listening. Maybe you're interested in markets. Maybe you're just trying to get good at something new. So where did this whole thing even start, this experiment?
Well, the origin story is pretty legendary itself. It kicked off with this big debate back in the early 80s
Okay.
between two trading giants. Richard Dennis, who was this hugely successful commodities trader,
Right.
he was absolutely convinced trading was a skill you could teach, like learning to play chess or something.
But his partner, William Eckhart, he thought Dennis was wrong.
Completely wrong.
Yeah.
Yeah, Eckhart was firmly in the camp of you've either got it or you don't. He thought it was intuitive talent, something you're born with.
Wow. So a fundamental disagreement. Nature versus nurture, but for trading.
Pretty much. And to settle it, they didn't just argue. They set up this incredible experiment back in 1983.
And how'd they find people?
They actually put ads in the paper looking for applicants. And here's the interesting part.
Right.
They weren't necessarily looking for people with finance backgrounds.
Yeah.
No, they picked 23 people from all sorts of backgrounds.
Yeah.
Diverse group. Didn't matter if they knew anything about trading beforehand.
That's amazing. And the training itself was super short, wasn't it?
Just 2 weeks.
2 weeks to learn trading.
Yep. 2 weeks to learn a very specific set of rules, mechanical rules for trend following. And then, here's the kicker.
Uh-huh.
Dennis gave them his own money to trade. Real capital.
Wow. Talk about putting your money where your mouth is. High stakes from day one.
Absolutely. And this group, they famously became known as the Turtles.
The turtles. Why turtles?
Came from a trip Dennis took to Singapore. He saw these turtle farms and apparently said something like, we are going to grow traders just like they grow turtles in Singapore.
Huh. So traders could be cultivated, farmed, basically, proving his point.
Exactly. That it wasn't innate. You could nurture it.
Okay, so these turtles, they had a system, rules. What was the core idea behind it? Because most people think trading is, gut calls, reading the news.
Yeah, this is the opposite of that. It was purely mechanical. Their whole philosophy was basically ride the trend until it ends.
Ride the trend until it ends. Simple.
Simple in concept, yeah. They weren't trying to predict where the market was going next. That's, where a lot of people go wrong.
Right, trying to be smarter than the market.
Instead, they just reacted to what the price was doing, following the trend, not forecasting it.
Okay, fascinating. So reacting, not predicting. Can you break down some of the key parts of that system? Like how do they know when to jump into a trade?
Sure. So for entries, they use something called price breakouts,
Breakouts,
meaning buying when the price moved above a certain recent high. Specifically, they often use like a 20-day high or sometimes a 55-day high. The idea was this signals a potential new upward trend starting. And importantly, if that breakout failed, like if the price popped up and then quickly fell back down, that was a signal too. Either get out quick or don't get in.
got it. And risk management. That's always the big one in trading. Their approach to position sizing seems really clever. How do they handle that, especially with different markets moving differently?
Yeah, this is maybe the most crucial part. It was all about managing risk based on volatility. They use a measure called the average true range, or ATR.
AOTR, right. Measures how much something tends to move.
Exactly. And they use that ATR to calculate a risk unit, which they called M. So for every single trade, no matter the market, could be volatile oil, could be calmer currencies, the dollar amount they were risking was consistent.
So it wasn't about buying the same number of contracts. It was about risking the same amount of money per trade based on its specific volatility.
Precisely. That way, no single losing trade could blow up their account. It standardized the risk across everything they traded.
That's incredibly smart. Okay, so consistent risk. What about getting out? Cutting losses or taking profits? Was that just as mechanical?
Oh, absolutely. Strict stop-loss rules were fundamental. If a trade went against them by a certain amount, again often defined using N, they were out. No questions asked, no hoping it would turn around.
Emotion completely removed.
That was the goal. And exits for profits were also rule-based. Often it involved exiting if the price broke below a recent low, say a 10-day or 20-day low, signaling the trend might be over.
Okay, so mechanical entries, mechanical exits, controlled risk. And they didn't just place one bet, right? They scaled in.
That's right, they used pyramiding. So if a trade started working, moving in their favor, they would add to the position.
Adding to winners.
Exactly.
Yep.
But they had specific rules for how much to add and when, again tied back to that volatility measure N. This let them really capitalize on the big, long-running trends when they caught one. Let the winners run, essentially.
Makes sense. You want to make the most of it when you're right.
And the final piece, of course, was diversification. They weren't just trading one thing.
Right. Spread the bets.
Yeah, they traded across lots of different markets, commodities, currencies, bonds, you name it. Spreading the risk. So if one market was quiet or choppy, maybe another one was trending strongly.
Okay, so we have this clear, mechanical, risk-managed system. What were the big lessons learned from this whole experiment? What really stood out?
Well, the number one lesson, the one that kind of underpins everything else, was the absolute necessity of discipline.
Discipline. Why was that so critical, more than just having the rules?
Because having the rules is one thing, but actually following them day in and day out, especially when it feels wrong or scary or when you're bored, that's the hard part.
Yeah, I can imagine. Your gut might be screaming to do something else.
Exactly. And the turtles had to execute the rules perfectly without letting fear or greed interfere. For them, deviating from the system was the failure, even if that one stray trade happened to make money by luck.
Interesting. So the process was valued over the immediate outcome.
Absolutely. It was about consistency over hundreds, thousands of trades.
And that discipline, that focus on process, it really shattered that myth about needing special talent, didn't it?
Completely. It proved that, ordinary people, given a solid system and the mental fortitude to stick to it, could learn to trade successfully. It shifted the focus from innate brilliance to structure and execution.
The power of a mechanical system really shines through there.
It does. Because rules-based systems, they filter out all the emotional noise, the news headlines, the gut feelings that usually trip traders up. The turtles weren't making predictions based on what they thought should happen.
They were just following the signals.
Just following the signals, which leads to another really key insight.
Which is
Risk management being more important than prediction. This is huge.
more important than being right about the direction.
In the long run, yes. Their system was built to survive losing streaks. The position sizing, the stop losses, it ensured they could take hits and still be in the game. Managing the downside was prioritized over predicting the upside perfectly.
That makes a lot of sense. You can't win if you're not in the game anymore.
Exactly. And finally, it just demonstrated that trend following, as a strategy, works over the long haul. You ride the big moves, you cut the losses short. It worked across different markets, different eras. It validated the core approach.
And the results. They weren't just okay, were they? They were pretty spectacular.
Oh, astonishing is the word. Over about 4 years, some of these turtles, these regular folks trained for 2 weeks, were generating returns over 100% per year.
Wow, 100% per year.
Yeah. Many became multimillionaire traders. Some went on to start and manage their own successful hedge funds. It was definitive proof for Richard Dennis. Trading can be taught.
Incredible. Beyond the numbers, what about the sort of psychological lessons, the mindset stuff?
That's almost as fascinating. The book really hammers home that fear and greed destroy more traders than bad strategies.
That rings true even outside trading.
Doesn't it? It suggests that emotional control is maybe the biggest hurdle. And the turtles' confidence, it didn't come from feeling like they knew the future.
Where did it come from then?
It came from trusting the process, from knowing they had a system with an edge and their job was just to execute it flawlessly. It wasn't about being smarter than everyone else. It was about being more disciplined. Consistency was key, not raw intelligence.
That's a powerful shift in perspective.
And there's some great quotes in the book that capture this, like, good trading is not about being right. It's about trading right.
Process over outcome again.
Exactly. Or another one, if you diversify, control your risk, and go with the trend, it just has to work. It sounds simple, but living it is the challenge.
Yeah.
And maybe the most liberating one for anyone feeling overwhelmed by uncertainty. You don't need to know what's going to happen next to make money.
Just react to what is happening based on your rules.
Precisely. It takes away that pressure to be a fortune teller.
So let's wrap this up. The core insight from the complete turtle trader. It's way more than just a cool story about a trading debt, isn't it?
Oh, much more. It's really like a blueprint for disciplined, systematic success in any high-performance field. It shows how regular people, with clear rules and, critically, the psychological discipline to follow them, can achieve truly amazing things.
And why should you listening right now care about this?
Well, because these principles, having a clear system, unwavering discipline, smart risk management, and this whole idea that talent might be overrated compared to process these things,
Yeah.
apply everywhere.
Yeah, not just trading floors.
Not at all. Learning an instrument, building a business, mastering a sport, writing, you name it. The underlying principles are remarkably similar.
So it leaves us with a final thought, maybe something provocative for you to chew on. If success in something as complex, as notoriously difficult and volatile as financial trading can actually be broken down into a teachable system that novices can master, well, what other things that we currently call talent are actually just skills?
Skills waiting for the right set of rules, the right structure.
And the discipline to stick with them. What else could be grown just like those turtles?
It's a fascinating question to ponder, isn't it? Makes you rethink the limits of what's learnable.